In this example, we're looking at ABC, who purchases its goods from its key supplier on terms of 115 net 45. As of now, they don't take the discount, but instead they pay on the 45th day after purchase, so they're not taking the 1% discount. Two questions. What's the nominal annual cost of trade credit that ABC is paying for its payables? And the second part is that what happens after the announcement of new trade credit terms going to 210 net 30. Well, first things first, let's calculate the nominal cost of trade credit. The 115 net 45, that means there's a 1% discount if invoices are paid within 15 days. That's the free trade credit period. Otherwise, the full invoice is due after 45 days. So that would mean that if ABC paid by day 15 and invoice for, say, $100,000, the actual cost they would pay would be $99,000. Let's save $1,000 for paying on day 15. If ABC paid by day 45 and invoice for $100,000, they pay $100,000. Okay, so what's the difference? $1,000. So the real cost of the inventory is the cash cost, $99,000. And if they don't pay for it within the first 15 days during the free trade credit period, then they're essentially borrowing the money from day 16 through day 45, roughly 30 days. So the 30-day interest rate, if you will, for 30 days would be $1,000 on a $99,000 invoice. Okay, still only 1%, which we can also get by taking the 1 divided by 100 minus 1. That's 1 from the 115. That 1 divided by the net invoice amount, which would be 100% minus the 1% discount. So that's the interest rate. To annualize that into days, or how many of those periods per year, well, the loan would go from day 15 to day 45. That's essentially 30 days. So there are a little over 12 30-day periods in a 365-day year. So the annual cost, or the annualized cost, I guess I should say, because remember from the other module we restate interest rates based on the annual cost of borrowing. Is just a little bit over 12%. Okay, and for a lot of companies, 12% is just not worth messing with. You know, you pay 18% on a credit card, so the annualized cost of 12% might not seem like all that much for the loan for this particular company. On the other hand, if the company then switched, going forward, we're going to have new credit terms at 210 net 30, what that'll mean that currently they're not paying that much for the borrowing arrangement, but the cost just went up. All right, so the new cost 2 divided by 100 minus 2. So the net cost at 210 net 30 is you're going to pay 98% of the invoice cost. So if you don't pay within the free trade credit period, you're going to pay an extra $2 for every $98 worth of invoice. The 210 net 30, so you're actually borrowing from day 10 to day 30. There are 20 periods in there, so that'd be 365 days in a year. There are 18 and a quarter 20-day periods. If we multiply 18.25 periods per year, and each period costs you a little over 2%, the cost of trade credit just went from about 12%, roughly what you'd use on a credit card, to 37%, roughly what you would pay on a credit card if you had really bad credit. All right, so it's in this company's interest to start taking the trade credit, and depending on how much that they borrow, they can actually go to the bank and probably make an arrangement to pay, I don't know, 12%, 15%, as long as it's less than 37%. What they need to do is pay down the invoices. Right now they have 45 days of invoices outstanding, and let's assume that ABC buys, call it $5 million per year from its key supplier. That's purchases per day would be equal to 5 million divided by 365. That's about $13,000, 13,698, around 13,700 per day. The days payables outstanding are currently 45 days. So its accounts payable from this company is currently about $600,000. All right, so what's happening is that their key supplier is tightening up on credit terms because they probably have too many accounts receivable sitting out. So this company's still going to be purchasing, ABC is still going to be purchasing the same amount, but now what they have to do is either pay it down to 30 days, which means that they need to go make arrangements to raise $200,000 in working capital. On the other hand, they could also make arrangements, as long as you're borrowing some money or raising capital otherwise, take it down to 10 days. That would mean that the accounts receivable would have to go from 616 down to 136, which would be a decrease of close to $500,000. Okay. On the other hand, the annual savings would be $5 million times 2%. So you're going to actually save, or ABC would actually save, about $100,000 a year because now they can take the discount. The annual cost, let's say they have to borrow at 15% and they get an interest-only loan at 15%. A line of credit costs them $71,918 at 15% every year. They would still save $28,082. So depending on the cost of the trade credit, you know, if they can borrow at 15%, then the current arrangement of raising trade credit at a little over 12% is advantageous to them. Of course, if their supplier changes the terms, which they can do anytime they feel like, at 37%, then ABC ought to be scrambling around. If they continue to pay if they continued paying on the last day available, they still have to raise $200,000 to reduce the payables, and they still wouldn't get a discount. And that's why I'm saying it probably would make more sense to go ahead if they can borrow at 15%, if they take the payables down to $137,000, roughly 10 days of purchases, then even at 15%, they're going to save roughly $28,000.